Welcome to the Deep Dive, your shortcut to being genuinely well-informed. We grab the most interesting stuff out there, articles, research, notes, and boil it down into those brilliant aha moments just for you. No noise, just pure insight. Today, we're pulling back the curtain on some really critical, but maybe less talked about, operations inside a business. We're diving deep into what auditors call other transaction cycles. Basically, how companies handle their big assets, how they manage payroll, getting everyone paid, and how they deal with their financing, like debt and equity. And maybe the most fascinating part, how auditors check every single piece of it. It's amazing how these backstage processes really shape the whole financial picture.
It really is.
Yeah.
Because understanding these cycles helps you see how a business really ticks.
Yeah.
Beyond just the profit numbers or the headlines. Think of it like the engine room. And our sources for this are actually detailed excerpts on auditing procedures, so we're getting a real peek behind the scenes at how this financial checking actually happens.
Okay, let's get into it then. Let's unpack the first big one, the property, plant, and equipment cycle. PP&E. These are the the really tangible things, right? Yeah, PP&E, property, plant, and equipment. We're basically talking about the big physical stuff a company owns and uses for more than a year. Things they use in the business, not stuff they plan to sell quickly. Think buildings, big machinery, maybe a whole fleet of trucks. And the main things happening here are like buying them, fixing them up, accounting for how they wear out depreciation, getting rid of them eventually, and even leasing.
Exactly. And because these assets are often super valuable, sometimes millions of dollars, having really strong internal controls is absolutely vital. These are the company's own checks and balances. So for instance, when a company wants to buy a major piece of equipment, say a new production line, it's a big deal. There's a special form, a requisition that details, what it is, why they need it, the cost, which department gets it. And this isn't just a suggestion box thing. It has to get signed off by top management, maybe even the board. It's usually tied directly to the big capital budget the board already approved. And if the cost is way off from the budget, they investigate that right away. Auditors spend a lot of time checking that the company followed its own rules here, that the approvals were legit.
Okay, so approval is key. What else? How do they keep track of everything once they own it?
Good question. Each asset gets its own detailed record, kind of like a digital passport, in what's called a subsidiary ledger. This isn't just a simple list. It's got a description, an ID number, where it is physically, when they bought it, the cost, how they're depreciating it, how much depreciation is built up. It's quite detailed.
Right.
And for physical security, think identification plates, like serial numbers, stuck right on the equipment. These numbers link back to those ledger records. You need physical controls too, fences, locked areas, whatever, to stop theft or damage. Plus, regular physical checks, just going out and confirming the assets are actually there. Auditors will test this, comparing serial numbers they see to the records.
And imagine having clear rules for things like depreciation is important too.
Oh, absolutely. You need written policies for depreciation and also for capitalization that's deciding if something is a long-term asset or just a short-term expense. Clear rules stop companies from maybe playing games with the reported profits. And then there's getting rid of assets disposition. That needs control too, usually a special work order, numbered sequentially, with proper authorization saying why it's being retired or sold. This form is crucial for taking the asset and its depreciation off the books correctly. And here's a really, really important point a passkey auditors look for. Segregation of duties.
Meaning different people doing different things.
Exactly. The people who authorize getting rid of an asset should not be the ones who actually handle the disposal or collect any cash from selling it. It prevents someone from, say, authorizing the disposal of a perfectly good laptop and then taking it home.
That makes total sense. It paints a clear picture of the internal safeguards. So what does this all mean when an auditor comes in and check everything out? How do they approach auditing PP&E?
Right, so the auditor's job is basically to get comfortable with a few core assertions about these assets. Do they actually exist? Is everything that should be recorded actually recorded that's completeness? Are they valued correctly? Does the company truly own them, rights and obligations? And is everything presented clearly? So for completeness, we'll get the company's whole list of fixed assets, the detailed schedule. We'll foot it, basically, add it all up and make sure the total matches the main accounting records, the general ledger. We also check the math on lists of new additions and disposals during the year, and we might pick a sample of actual physical assets we see on the factory floor and trace them back to that detailed ledger to make sure they're recorded.
Okay, footing and tracing back. What about proving they exist?
That's where existence testing comes in, often through vouching. It's like tracing forward. We pick an item from the asset ledger and vouch it back to the supporting documents. We look at the internal purchase requisition, the external vendor invoice, maybe even shipping documents. Sometimes we physically go look at the specific asset. It's about finding the proof. We also test rights and obligations by looking at things like invoices, property deeds, vehicle titles, documents that prove ownership.
And valuation, making sure the number on the books is right.
For valuation and allocation, we'll recalculate the company's depreciation calculations for reasonableness. A big piece is also evaluating potential impairment. We look for signs that an asset's carrying value, its book value, might not be recoverable. Maybe it's damaged, obsolete technology, or not being used efficiently. If we see signs, we examine the company's analysis or even redo the impairment calculation ourselves. Some standards, like IFRS, even allow for revaluing assets upwards, which also needs checking.
Got it. So you're checking additions, disposals, depreciation, ownership. What about the transactions themselves, like the day-to-day stuff related to PP&E?
Yeah, auditors often use what we call dual-purpose tests here, looking at both the internal controls and the transaction details simultaneously. For transaction completeness, we might trace purchase requisitions through to the receiving reports and ultimately into the asset ledger. But here's where it gets really interesting.
Uh-oh. What's the interesting part?
We often spend significant time reviewing the repair and maintenance expense accounts.
Why there? That sounds like just routine expenses.
Exactly. But sometimes companies might try to hide the purchase of a significant asset by recording it as a repair expense. Maybe to make their current profits look lower or sometimes higher if they capitalize routine repairs.
Ah, I see. So expensing something that should have been capitalized as an asset?
Precisely. It can really distort the financial picture. Finding those is a key part of the audit. We also review lease agreements, making sure they're correctly classified as either finance leases, which are like buying the asset, or operating leases, which are more like renting. That classification has big accounting impacts.
Okay, that's clever. Looking for assets disguised as expenses. What else for transactions?
We check cutoff. We look closely at purchases and disposals happening right around the year-end date to make sure they landed in the correct accounting period, not recording a December purchase until January, for example. For valuation, allocation, and accuracy, we recalculate depreciation expense for the period, make sure it follows the rules GAAP or IFRS. We test any gains or losses recorded when assets were sold, making sure the asset and its accumulated depreciation were removed correctly. For existence and occurrence, we vouch purchases back to things like receiving reports and vendor invoices. And for disposals, we vouch them back to those authorized asset retirement forms we talked about earlier.
And finally, making sure it's all clear in the reports.
Right. Understandability of presentation and classification. We double-check those repair accounts for capitalized items, review lease classifications again, and for the overall presentation and disclosure, we make sure all the required details are in the notes to the financial statements. Things like the depreciation methods used, the useful lives they assume for assets, the total expense for the year, the balance broken down by asset class, total accumulated depreciation, any liens or mortgages against the assets, and details on leases. We read these footnotes carefully to ensure they're accurate, complete, and easy to understand.
Wow, it sounds like auditors really leave no stone unturned when it comes to a company's tangible assets. That's incredibly thorough. But what about something maybe less tangible but just as vital, like paying people? That leads us straight into the payroll and personnel cycle. All right, let's shift gears seamlessly then to something we can all definitely relate to: getting paid. What's fascinating, I think, is figuring out how companies make sure everyone gets paid the right amount and that everyone getting paid actually, works there. Because the two biggest risks here, apparently, are paying fictitious employees, ghosts on the payroll, and real employees maybe fudging their hours.
Absolutely. Payroll fraud can be a huge drain on a company. And, many companies actually use external service organizations now to handle their payroll processing.
Like ADP or Paychecks.
Exactly. But even if they outsource it, the company's still responsible. And as auditors, we need to understand the controls at that service provider if they significantly impact the payroll process. But whether it's done in-house or outsourced, the absolute #1 control principle here is segregation of duties. It's crucial.
Okay, break that down for payroll. What needs to be separate?
Think about the different steps. First, authorization to employ and pay. That's the job of human resources, or HR. They do the hiring, they set the pay rates, they maintain the official personnel files where hire dates, job titles, salaries, deductions, all that.
Got it. HR hires and sets the pay.
Second, supervision. The employee's direct boss is usually responsible for approving the actual time worked, signing off on timesheets, approving overtime, tracking absences, or paid time off. Third, timekeeping and cost accounting. This is about gathering the raw data hours worked, perhaps jobs completed if it's piece rate pay. This needs to be independent, maybe time clocks for hourly folks or electronic time tracking systems. Supervisors might compare job tickets to time clock records.
Okay, HR hires, supervisor approves time, timekeeping records it. Then who actually calculates the paycheck?
That's step 4. Payroll check preparation. This is usually a dedicated payroll department. They take the authorized pay rates from HR and the approved hours from supervisors, calculate gross pay, deductions, net pay, and then prepare the actual but still unsigned checks or the direct deposit files. Now, here's another critical pass-key moment for auditors. The payroll department is purely a record-keeping function. They process the data. They should not have the authority to change pay rates or hours submitted, and crucially, they should not have the ability to sign the checks or authorize the bank transfers.
Right, because then they could potentially create fake employees or inflate hours and pay themselves.
Precisely. The authority to actually release the funds, like signing checks or approving the direct deposit batch, should rest with someone like the treasurer or CFO. And they need strong controls over blank checks or the digital equivalent, like access to the payment systems.
Okay, so the final step is getting the money to the employee.
Yes, check distribution. Nowadays, it's mostly direct deposit, which has its own controls. But if physical checks are still used, they absolutely must be distributed by someone completely independent of all the other payroll functions, sometimes called a paymaster. This person shouldn't be from HR, shouldn't be a supervisor, shouldn't be in payroll prep. They should ask for ID, and any checks that aren't claimed need to be followed up on immediately by someone independent, like internal audit. Internal audit often plays a role here too, maybe periodically comparing the active payroll file against the HR personnel files just to make sure everyone being paid is a legitimate current employee. You'd be surprised how often ghost employees pop up if controls are weak.
Those controls sound incredibly thorough, especially the segregation of duties.
Yeah.
But I can imagine in a really large company, making sure all those separations are strictly maintained must be tough. Are there common areas where things slip through the cracks? And how does an auditor actually test if these controls are working?
That's a great point. Maintaining strict segregation in huge organizations can be a challenge, and yes, sometimes controls aren't designed perfectly, or they aren't followed consistently. That's what auditors test. When we evaluate the internal controls over payroll, we do things like observe the segregation of duties in practice. We watch who's doing what. We compare personnel records held by HR to actual time cards or electronic records. We might even show up unannounced during a payroll distribution if they use physical checks to see who picks them up and verify identities. Or just walk around departments and compare employee lists to who we physically see working.
Like a head count.
Sort of, yeah. We also observe how time clocks are used or how electronic time is approved and investigate any anomalies, like consistently unused time cards. If they use direct deposit, we test the electronic transfers and trace them back to employee authorizations and HR files. We also test controls within the payroll system itself. Are there checks to make sure hours worked aren't ridiculously high? Does the system prevent adding employees who don't exist in the HR master file? Things like that.
Okay, so you test the controls. What about auditing the actual payroll numbers that end up in the financial statements, like the year-end accrual for wages earned but not yet paid?
Right, auditing the payroll accrual. If we've tested the controls and found them to be effective, we can often rely more on analytical procedures here. We'd recalculate the company's year-end accrual based on the last pay period and the number of days remaining in the year. For completeness, we check if all earned wages seem to be included. For valuation, we do that recalculation and compare our number to what they recorded. For existence and rights and obligations, we might vouch amounts in their calculation back to supporting payroll summaries to ensure it's a real obligation of the company.
And the payroll transactions themselves during the year.
Yes, those dual-purpose tests again. For completeness, we might trace a sample of time cards through to the payroll register to ensure they got paid. For cutoff, we examine time records right before and after year-end to ensure payroll expense is in the right period. For valuation, allocation, and accuracy, this is a big one. We compare recorded payroll expense to the actual checks or direct deposits issued. We test the math, footing the payroll register, checking extensions. We verify pay rates and deductions against the authorized HR records. We recalculate gross and net pay for a sample of employees.
So really reperforming the payroll calculation for some employees.
Exactly. We might also compare payroll costs to budgets or standards if they have them. For existence and occurrence, we select employees from the payroll register and vouch their time back to approved timesheets or time clock data. We also perform procedures to confirm these selected employees actually exist and were employed during that pay period. And finally, understandability of presentation and classification. We check that payroll costs are charged to the correct expense accounts, manufacturing labor versus sales salaries, for instance. And for presentation and disclosure, we make sure all the required details about things like pension plans, post-retirement benefits, stock-based compensation, or deferred compensation plans are properly disclosed in the financial statement notes. We read those footnotes for accuracy and clarity.
That's a truly comprehensive look at the human side of a company's finances. It really highlights how HR and finance have to work hand in glove. Okay, we've covered assets, we've covered people. Let's move to how the company funds everything, the financing cycle, debt and equity.
Right, this cycle is all about where the money comes from to run the business, beyond just daily operations. And starting with debt, controls are, again, really important. You need adequate documentation for every financing agreement. Loans, bonds, lines of credit, everything written down. Any new debt, especially significant amounts, absolutely has to be authorized, usually by the board of directors or very senior management. And that authorization needs to be documented, typically in the board minutes. Companies also need detailed records of all their long-term debt. And importantly, there should be periodic independent checks comparing the company's internal records to what the actual lenders or bondholders say is outstanding.
So confirming the balances externally.
Yes, exactly. Plus, you need good controls over making the actual interest and principal payments on time and correctly accounting for any bond premiums or discounts over the life of the debt.
Okay, that covers debt. What about equity, the ownership side?
Controls over equity are similarly focused on authorization and record keeping. Any issuance of new stock, any declaration of dividends, any decision to buy back company stock, treasury stock. All of these must be formally authorized by the board of directors. Again, the board minutes are the key evidence trail. Now, many larger companies use what's called a stock transfer agent. This is an external specialist, like a bank or trust company, that handles all the mechanics of stock issuance.
What do they do exactly?
They make sure the company follows its own rules and any legal requirements for issuing stock. They prepare the actual stock certificates or manage the electronic records, and they maintain the official list of shareholders and how many shares each owns. They basically act as the independent registrar.
So if a company uses one, that helps with controls.
Definitely. It provides a layer of independent verification. But if a company doesn't use a transfer agent, maybe a smaller private company, then an officer of the company has to be designated to handle these tasks. They maintain the stock certificate book, track issuances and cancellations. And critically, again, segregation of duties, this officer shouldn't have other major accounting responsibilities. There also needs to be a regular independent reconciliation between that stock certificate book and the number of shares shown as outstanding in the main accounting records.
It sounds like the board of directors signs off on almost everything in this cycle. Lots of high-level approvals for debt and equity changes. How do auditors wrap their heads around all that and verify it?
You're right, the board minutes are a crucial starting point for auditing this cycle. When we audit the debt balance, for completeness, we start by reading those minutes to see if any new debt was authorized. We then get copies of any new loan agreements or bond indentures and trace the amounts into the financial statements. We also obtain confirmations directly from banks about loans outstanding, and we can confirm bonds directly with the bond trustee or individual holders.
So external confirmation is big here too.
Very big for both existence and completeness of debt. We also get a listing of all the company's recorded debt and agree the total to the general ledger. And we ask management specifically about any new borrowing or any off-balance sheet financing they might have. For valuation and allocation, we examine the terms of new debt agreements to make sure they're recorded at the right amounts initially. We also recalculate the interest that should have accrued by year-end, interest payable, and recompute the amortization of any bond premiums or discounts.
Making sure the ongoing cost is right.
Exactly. For existence, those direct confirmations with creditors are the primary evidence. And for rights and obligations, we examine the actual note and bond agreements to confirm the debt legally belongs to the company.
Okay, that's the balance. What about the debt transactions during the year? New borrowings, repayments?
Similar dual-purpose tests apply. For completeness of transactions, we again look at board minutes and new agreements. We might also scan the interest expense account, looking for payments made to lenders who aren't on the company's main debt schedule that could signal unrecorded debt. We also check lease agreements again here for proper classification, as some leases are essentially debt. For cutoff, we review debt activity right around year-end. For valuation, allocation, and accuracy, we test the amounts received from new borrowings and the amounts paid for principal and interest. We often perform analytical tests, like comparing the reported interest expense to the average debt balance to see if it seems reasonable.
A quick sanity check.
Kind of, yeah. For existence and occurrence, we verify new debt issuances by looking at the board minutes and inspecting the signed agreements. And for understandability of presentation classification, a key thing is examining due dates to make sure debt is correctly classified as either short-term or long-term on the balance sheet.
And the disclosures, the fine print.
Absolutely critical for debt. Under presentation and disclosure, we check that all required information is there in the notes. This includes things like maturity dates, interest rates, any special features like call or conversion options, details of any assets pledged as collateral, future principal payment requirements like sinking funds, and any restrictive covenants rules the company has to follow under the debt agreement. We read these footnotes for accuracy and clarity.
Okay, that's a deep dive into debt. What about the equity side? Auditing stock transactions and balances.
Auditing the equity balance and transactions follows similar principles, focusing on completeness, valuation, existence occurrence, and presentation. For completeness, if the company uses a stock transfer agent, getting a confirmation directly from them is usually sufficient evidence for the number of shares outstanding. It's reliable third-party evidence. If there's no transfer agent, the auditor's main source is the company's own stock certificate book. We'll examine the stubs for issued certificates, look at canceled certificates, account for unissued ones, foot the number of outstanding shares from the stubs, and agree that total to the general ledger control account. We also examine any treasury stock transactions and physically inspect the repurchase certificates if they're held by the company.
So really getting into the details if there's no agent.
You have to. For valuation, we recompute the value recorded for any stock issued during the year, like cash received or value of assets received. We also analyze the retained earnings account, usually starting from the balance confirmed in the prior year's audit, and review any direct entries made to retained earnings to ensure they're appropriate. For existence and occurrence, we vouch stock transactions back to authorization in the board minutes. We use that transfer agent confirmation if available, or we inspect the stock certificate book.
And finally, presentation for equity.
Yes, understandability of presentation and classification. We determine if there are any restrictions on retained earnings, perhaps due to loan agreements, state laws, or board actions, appropriations. We inquire about these and ensure they are properly disclosed. We also check that all the required disclosures about equity are present and clear in the footnotes. This includes details like the number of shares authorized, issued, and outstanding for each class of stock, the rights and privileges of different securities, like preferred stock dividends, information on stock option plans, and those retained earnings appropriations or restrictions. Making sure investors have the full picture of the company's ownership structure and any constraints.
Wow, what a journey. We went from, the solid physical assets like buildings and machines and PK&E, then to the really human side with payroll, and finally the financial engine itself, debt and equity. Understanding these other transaction cycles really does give you a much deeper appreciation for how companies actually manage their core operations day to day, and how absolutely vital that auditing process is to make sure everything is accurate and transparent. It's like seeing the intricate gears inside a watch, not just the time it tells on the face.
That's a great analogy, and if you connect this to the bigger picture, it just highlights that every single number you see on a financial statement, every asset, every expense, every bit of debt or equity, it's all the end result of a process that needs to be carefully managed. Or sometimes it's mismanaged. And the auditors, well, they're kind of like the detectives, making sure those underlying processes are sound, trying to give everyone, investors, lenders, management, confidence in those final numbers.
So here's something to think about. The next time you hear about a company's quarterly results, or you see them building a new headquarters, or maybe even when you just get your own paycheck, pause for a second. Consider not just the final number, but that whole complex, interconnected web of controls, authorizations, and verifications humming along behind the scenes. That invisible machinery underpinning every asset, every paycheck, every dollar borrowed or invested. How much do you think those invisible processes truly influence a company's success, its stability, and even its reputation? Thank you so much for joining us on this deep dive. Keep learning, keep questioning, and we'll catch you on the next one.